prices rising even further. So we now have this new short-run aggregate supply curve with a higher expected inflation rate. Now notice that at pi 1, we still have excess supply, or we have excess supply. Producers want to be at potential output. Purchasers, buyers want to be at point B. That excess supply is going to cause inflation to decelerate, which will have an effect both on producers as well as buyers. Lower inflation, lower real interest rate, higher planned expenditures, higher real economic output. So the economy now adjusts to point C. We have somewhat lower inflation and somewhat higher economic output. The output gap is beginning to narrow, so the unemployment gap would also be beginning to narrow. Where do we end up? Where's our final general equilibrium? Remember the rule of thumb. Final general equilibrium is always at the intersection of the relevant aggregate demand curve and the relevant long-run aggregate supply curve. Notice neither one of them shifted. So the relevant intersection of those two is still point A. It's right where we started. So where we're going to end up at point N is exactly where we started. Temporary aggregate supply shocks do not cause permanent changes in inflation, nor do they produce permanent changes in the output gap. So we're right back there. Now again, the reason for this is oil prices went up, and then they stopped going up. Food prices went up, and then they stopped going up. So if we think about inflation as how fast prices are changing, they change a lot when oil prices and food prices initially rise. But once they stop changing, you don't get that big push from higher food and energy prices, so inflation now begins to settle back down. Notice, the fact that inflation doesn't change in the long run does not mean that prices aren't a lot higher. The price level, as opposed to the change in the price level will indeed be higher. Right? It's rising by whatever these inflation rates are. These were higher than they were here, so prices accelerated, and now they've sort of topped out their growth rate at where they began. Now notice the adjustment pattern that takes place here. It's a very tight, again, counter-cyclical or counterclockwise loop. And here's a period where we could see exactly that happening. Notice here's the unemployment rate rising. Here's inflation with energy and food, and here's inflation without it. So unemployment and inflation both rising at the same time. It's a pretty good indication you've had a negative price shock. Whether it's temporary or not may be difficult to know at the beginning. And here, following, a couple of years later, we had a second shock. So our first shock in 1973 was the initial OPEC price shock. We also had food and wage and prices. But again, in 1979, 1980, the Iranian Revolution led to another big jump in food and energy prices as well. So you have unemployment and inflation both going up at the same time. Now recall what happened right in here. This is 1981. Inflation was very high. Remember that negative aggregate demand shock we had? Told you that the Federal Reserve increased the real interest rate dramatically. And this is what happened afterwards. So we had a negative shock followed by a negative short-run aggregate supply shock followed by a negative aggregate demand shock. That was a lot of fun to live through. No, it wasn't. So you can see what happens. Here's the first shock. Unemployment rate goes way up. Here's the second shock. Just as the unemployment rate was coming down, notice there's a little break in here. So the unemployment rate had to come down from 8.3 to 6 between 75 and 78, and then it shoots right back up. Inflation went up and then started to come back down, exactly what we would expect from a negative short-run aggregate supply shock. Here, inflation goes up. We should have added one more year in here because we could see that inflation would come down quite a bit in 1981. Okay, now, we've looked at shocks to the aggregate demand curve and shocks to the short-run aggregate supply curve. We can also think about shocks to the long-run aggregate supply curve. Now, remember that the long-run aggregate supply curve is basically built on four factors, right? Labor, capital stock, total factor productivity, and changes in the efficiency with which the labor market operates, or the natural rate of unemployment. In general, especially for a country as large as the United States, permanent shocks would not occur due to changes in the labor force, changes in the capital stock, or changes in the natural rate of unemployment. I'm not saying those events couldn't happen. What I'm suggesting is those events, when they do happen, would be relatively small over, say, a 5-year horizon, that we really wouldn't want to treat them particularly as permanent shocks. Rather, most permanent shocks that I'm aware of come about because of changes in total factor productivity. Now, permanent shocks do not appear to happen very often. So in the post-World War II period for the United States, I am only aware of 3 for sure and 1 maybe. So the 3 for sure was the 1950s, when much of the new technology that was developed in World War II became commercialized. Second was in the mid-1970s, when we saw sharply higher oil prices. That also led to a bunch of other things happening there that seemed to lead to a significant change in how fast the economy could grow. And if you remember back at our long-run charts, one of the things we saw is that total factor productivity growth slowed significantly starting in the mid-1970s. And the third was starting in the mid-1990s when we had the commercialization of the internet and telecommunications and all of those types of information technology issues. Okay? So those are the three that I can identify for sure. The one that maybe, jury's still out, at least the jury in my mind is still out, is whether the financial crisis that we had in 2008 and 9 will end up constituting a permanent shock, or it will only be a very large aggregate demand shock that was poorly responded to. Okay, now again, when we think about permanent shocks, two things are going to happen here. One is we want to think about it in terms of what's going to happen to inflation. However, what happens to inflation is not going to be necessarily shown by what happens to the long-run aggregate supply curve. Rather, when we have a permanent shock, the long-run aggregate supply curve shifts, but so does the short-run aggregate supply curve. So they're both shifting. So now we can think, looking at that short-run curve, what's happening to inflation? If it shifts down, inflation is lower, we have a positive shock. If it shifts up and we have higher inflation, it would be a negative shock. So the example that everybody likes to use, and again, we only have really three to talk about, was the telecommunications information technology revolution that took place in the late 1990s. So this led to an increase in total factor productivity. There were also some things going on in the medical field that seemed to be reducing the rate of increase in medical care. I'm not sure that I think that this was all that significant a factor, so I'm not going to talk anymore about that. But what we'll see is we've got a permanent shock, and what we'll see is that this increase in total factor productivity was also a positive shock. So if we look at our diagram, start in general equilibrium, we now have this increase in total factor productivity. So potential output has increased. The economy's long-run aggregate supply curve has shifted out. Okay, now that's the long-run curve. Remember, permanent shocks affect not only the long-run curve, but also the short-run curve. So easy way to think about this is we're going to become more productive in the long run. Guess what? We can't become more productive in the long run if we're not also at least a little bit more productive in the short run. Right? Whatever these changes are that are taking place that's boosting long-run total factor productivity is likely to have at least some small positive effect on productivity in the short run. An increase in total factor productivity means the cost of production at any given level has gone down. So the cost of production is what we're building into our short-run aggregate supply curve. So now the short-run aggregate supply curve shifts down as well. What we have to ask ourselves is how far? If we continue to use our adaptive process for inflation expectations, then long-run equilibrium will be where expected inflation equals actual inflation. So the short-run aggregate supply curve will have to shift down so that it intersects the new long-run aggregate supply curve at an inflation rate of pi naught. So notice then the short-run curve shifts down not because of a change in expected inflation, but really we would treat this as a price shock. So the newer technology or the newer productivities reduce the cost of production. We need to reflect that. We'll treat that as a price shock. So the short-run curve shifts down. Now we need to think about where planned expenditures are versus what producers want to produce. Well, we know what producers want to produce. At an inflation rate of pi naught, they want to be out here at the red dot. But buyers are still in the aggregate demand curve. So they're still back here at point A. So once again, we have excess supply in the economy. We've talked about what will happen when you have excess supply. There will be adjustments on inflation and interest rates to get us to a new short-term equilibrium. In that new short-term equilibrium, the inflation rate will have fallen, and economic output will have risen relative to our initial potential output level. And because labor markets do not adjust quickly, the unemployment rate will go down. So at least in this first year, the output gap that we're looking at is with respect to the old potential output level. The unemployment rate will go down. So this is where we are in year one. Now, from here on, it's just like the adjustment mechanism that we've been talking about. Businesses were expecting inflation of pi naught. They got pi 1. So now they will adjust their inflation expectations downward. The short-run aggregate supply curve will shift down with this change in expected inflation. We'll have another adjustment, and we end up then with even lower inflation and higher economic output. And it's likely, given the slow adjustments in the labor market, that the unemployment rate went down yet again. And we know where we end up, right? It's always the intersection point of the relevant aggregate demand curve and the relevant long-run aggregate supply curve. So our short-run aggregate supply curve continues to shift down with inflation expectations continuing to chase and declining actual inflation rate until we get to pi naught. At this point, economic output is now up at its new potential level, and the unemployment rate is now back to the natural rate of unemployment. So we're actually back to the same unemployment rate that we had at point A. So what that means then, as the economy is growing through here, for the first couple of years, the unemployment rate will come down. But the more time goes on, the more adjustment we'll see in the labor market, and eventually, near the end of the adjustment process, the unemployment rate comes back up to the natural rate of unemployment. This is typically when you hear companies talking about rationalizing their labor force, right? We're back at potential output, but we see we hired too many workers, now we can readjust everything. Notice one of the beautiful things about positive long-run aggregate supply shocks. Inflation is permanently lower. Economic output is permanently higher. The unemployment rate hasn't changed, but economic output is permanently higher relative to where it would have been without that shock. And this is what you should expect to see. A long continuing decline in the unemployment rate and a long continuing decline in inflation. Okay. And here's the data to show it. The unemployment rate comes down, the inflation rate comes down as well. Okay, so on Thursday we'll pick up here, because I made some interesting charts. I want you to tell me what they mean. And then we'll move on to the money supply process. Okay, have a good evening, and I'll see you on Thursday.